take off, take flight with you. For we never fly, but we're flying.
Welcome back to another episode on Take Flight Podcast. This is a takeaway episode with myself, Pabilo Timbo. And in today's episode, I actually wanted to talk about a recent headline in the UK property investment world, and that's the reintroduction of 100% mortgages. So I wanted to very quickly share some more context, my thoughts, and perhaps what to consider for anyone that's listening and looking to weigh up this particular product as a first-time buyer. So Skipton Building Society announced a few weeks ago that they will be the first lender to offer a zero deposit mortgage. So this is where, just to be clear, they're allowing borrowers to take out 100% mortgage to purchase a property, which means if the property is valued at £350,000 on the housing market, you can actually borrow the entire £350,000. And I think for most listeners and most people would actually understand or have understood, in order to acquire a property, you would need to put down some level of down payment. So this might be new or sound quite strange and unique to people that are looking to actually buy their first property. So these mortgages are exclusively designed for first-time buyers who've actually struggled to get onto the housing ladder with either little to no deposit or no access to a gifted deposit and are actually currently renting. Now, to provide some context, we haven't seen a product like this in around 15 years since the financial crisis in 2008. And I'll share a little bit more around historical trends later on. Now, I think it's important to keep in mind that at the time of this recording, the average deposit for a first-time buyer is around £60,000 in the UK. And if you look at London specifically, it's over £115,000. And I think if you include the fact that rents are increasing year on year, you can actually perhaps see why a type of mortgage like this or type of product like this could be attractive to a number of first-time buyers. So the whole idea of sort of today's short segment is, with that in mind, understanding sort of the landscape, let's sort of cover the criteria and potential implications if someone, really is thinking about taking on this product. So the product itself is called a track record mortgage, and it's coming at a fixed 5-year period with an interest rate of 5.49%. There's no product fees, and the maximum term is 35 years. So in simple terms, you would actually be able to borrow the entire amount of the purchase price. You would fix that mortgage for 5 years, and you would pay an interest rate of 5.49 for that entire 5 years. And then after 5 years, the fixed period comes up, and you would then need to sort of go into a new fixed period. And you'll be doing that until the 35-year term. Now, in order to qualify for this product, here's what Skipton have actually said. You need to first be a first-time buyer. You need to be aged 21 and over. You need to have less than 5% deposit, so in effect, unable to put down a down payment. You can borrow up to only £600,000. This does not apply if you're looking for a new build flat, so it's an existing previous historical building in that sense. Each applicant needs to be in a position where they haven't missed any payments on their debt or credit commitment. So you need to have a really, really good credit file, and this is over a period of the last 6 months. And one of the number one criteria is that you have to have proof of having paid your rent 12 months in a row during the last 18 months. And you also have to have experience in actually paying some household bills for at least 12 months in a row during that 18-month period. So, unlike perhaps the financial crisis in 2008, where subprime mortgages were being given to anyone who actually asked for a mortgage, in this particular scenario, whilst the product sounds very similar from a distance, there is actually a criteria that is actually being applied before you can actually qualify for the loan. So let's say you're listening to this episode and you find that actually you're looking to buy your first property. And as I've gone through that criteria, you actually qualify, and you think there's actually a really, really good opportunity here for you, because it has been quite a challenge for you to save up the down payment over the years. So I've got a few points then for you to consider. So I think a couple of things. One, it's important to keep in mind that if you have little to no deposit, even with a guarantor, you're likely to be paying a much higher mortgage rate on your loan. So it's going to be a lot more expensive than if you had that down payment. And that's naturally how it works, right? So there's no such thing as a free lunch when you're borrowing at 100%. This product, there may be another lender that actually comes out later on in the year that offers a similar product. But what you'll tend to find is that this is only going to potentially be offered by maybe Skipton only, or maybe a few other lenders. So what you'll find is that it's going to be there are not many lenders for you to go to for this particular product. So you're kind of subject to whatever terms and fees one or two lenders are actually offering. And I say that because in an ideal scenario, as a first-time buyer, as an investor, you really want to have a plethora of lenders to be able to look into, because that can give you an opportunity as to where you can compare rates and have a bit more of a competitive advantage. The other thing to consider if you're a first-time buyer is, in the event that property prices fall, because we are in a very challenging economic environment, there is a risk that your mortgage is going to be worse than the total value of your home. And this is called negative equity. And it becomes an issue only when you're looking to perhaps remortgage, or in an event you want to sell, right? And so if you want to remortgage, for example, and you find yourself in negative equity, there are not perhaps many lenders that are going to be available to you. And again, it puts you in a very limited situation, and you're perhaps only subject to the lender you're currently with, which could then actually lead to paying perhaps maybe even higher rates at the end of the 5 years. So I think it's very important to understand that whilst as a first-time buyer you may qualify for something like this, what does it look like down the road? What does it look like after the 2, 3, 4, 5 year periods, and what's going to happen in that time? So a couple other points I think it's important to consider is, when I think about a first-time buyer as a profile, how much information and knowledge does that person have? You could actually argue that interest rates are likely to decrease over the next 5 years. So is it worth waiting for a little bit longer to build up some form of deposit before actually taking on a mortgage like this, where the rate is actually 5.49%? You might find in 2 years' time, the rates are lower and you're still locked in on that higher rate. I think if you are considering this product, there should be a plan up front to actually pay down some of the mortgage within that 5 years. So not just taking on 100% mortgage and actually then not even looking to perhaps at some point maybe pay extra payments or accelerate that payment to create some sort of a better, what we call loan to value. So there's some real equity there for you. A big point on this one for you to consider is, how sure are you on your employment status, especially in this current climate, right? And your means of income to afford the mortgage payments over the long run, because affordability over the long run is the most important factor when it comes to keeping your home. And so whilst, again, I go back to this point, whilst again, it may be quite attractive to get into this deal, what's the sort of viability over the long term? And how does your skill set look, or your employment or your industry looking over that term, in terms of you being able to hold on to your job? I think it's also important to consider the different scenarios on if you default on your rent and if you default on your home, because those are two completely different scenarios, completely different implications. And I think it's very important to understand, if you are currently renting, and again, this is a product that actually applies to you, and you think you're eligible for the loan, what happens if you miss your rent payments? What happens to your credit file or profile moving forward? What happens in the event you're unable to afford the mortgage payments? So something to keep in mind. And then I think, I think it's also important to make sure that you're just making those assumptions, right? In if it works out really well, what does that look like? If it perhaps doesn't work out necessarily so well, what does that look like? I think also as part of this session, I kind of wanted to share a few historical examples to keep in mind, because this is the context of borrowing 100% of something, right? And so 100% of the actual asset or purchase price. And we've seen examples in the past where, when consumers have actually borrowed or leveraged more than they can afford, what has tended to be the sort of implications or results. So I'll start with the Great Depression in 1929. This was, in summary, a stock market crash. And the essence behind this crash was people were effectively borrowing money they did not have to invest in the stock market, to have stock certificates that they did not actually understand. And so they borrowed from the bank, they mortgaged their homes in order to invest in the stock market. And inevitably, as that sort of climbed and reached its peak, when it started to decline, many people rushed out to liquidate and pull money out of the market. And obviously, of course, many people lost in that particular process. But the essence of there is people are borrowing more than they can afford when they don't actually fully understand the implications. Could be similar to some people for this product, 100% of mortgage. Second thing was the 2008 financial crisis. As I mentioned earlier, this was where lenders were offering subprime mortgages to anybody that was basically applying without, you didn't have to have any proof of income, no deposit. There wasn't hardly any checks here in the US. And that ended up as a catastrophe because ultimately, once people were able to start to default on their payments, that is where it started to turn. Property prices started to fall. All these properties went back to the bank. The investors that had an interest in those properties no longer wanted, and it just started to unravel and turn. And again, that is an example of where a group of people are borrowing 100%. I also need to add that Northern Rock was a bank that went under, and they were also offering 125% of the so they were giving you more money than the actual purchase price of the product. So it's important, because I recognize that a product like this is speaking to first-time buyers who may not necessarily have the knowledge, information, and are just thinking about wanting to jump onto the property ladder. But there are a number of implications to consider, and there are historical events for us to reference, which you need to take into consideration when making a decision. And the very last point, some closing points just to keep in mind. I think for someone who's looking into this, you should really try to understand the real intention of this product by Skipton or any lender, because it may only benefit a small number of people. And so the target audience that I think this applies to is someone who's actually unable to afford a down payment, but is paying perhaps maybe a relatively expensive rent and may not have necessarily the knowledge, right? And so that could be a recipe for disaster. Personally, I would actually suggest any first-time buyer who's considering this product, their criteria is you haven't missed a rent payment in 12 months. I would say 2 to 3 years, right? I would try to, extend and create that buffer, right? They want 12 months, but, honestly speaking, have I missed, has it just been 12 months, or can I actually show 2 to 3 years of paying my rent and I haven't actually missed a payment? I'd also say to perhaps be in a position where your mortgage payment, if this is a product that you take, is actually only around 30% of what you actually earn. A lot of times what you find, especially within the UK, mortgage payments are by far the highest expense for any individual person or family, and it could range anywhere between 40 to 50% of what they earn. And so the reason why I say perhaps if ideally you could perhaps put some criteria yourself, and it could just be 30%, is because this product is unlikely that anyone that is applying for this product has multiple sources of income, has multiple streams of income. So everything is riding on their employment. And so this is really the success, the key factor to your ability to keep this mortgage over its term. And we're in a very tricky, challenging environment today. So in addition to what Skipton or any other lender is actually looking for, I think personally there's a responsibility that the individual should look to say, I don't just meet these criterias, I meet these criterias plus more. And I think the final point to perhaps consider, especially for that first-time buyer, is you should plan for everything that could go possibly wrong and also right, and ensure you have a solution on either end, so you're not really hit with surprises. I think the worst scenario that I see is this applying to people that are quite vulnerable, in the sense of they have the means of income today, but because they lack the knowledge and they understand the real implications, it is not quite clear and doesn't work out very well. And that idea of wanting to jump on a property ladder and create wealth has been cut very short because your lack of knowledge or inability to perhaps look beyond what it takes just to get into a mortgage product. So yeah, very short episode. Just wanted to get a few points across. I hope some of these points have actually helped for any first-time buyer that potentially is listening to this, or any person in general actually that is thinking about this, because ultimately this is not a product for investors. It's only for first-time buyers. So maybe some of those points can help when you're actually weighing up your decision. And again, as always, it's important to mention, this is not financial advice. This is just sharing a few tips, nuggets for people to consider when making a decision. So I hope you've enjoyed it. And, if you've got any questions, reach out to me personally on Instagram or Take Flight Podcast. And we also have an email as well, takeflightpodcast@gmail.com. Until next time, speak soon.
Take off, take flight with you. Yeah, for we never fly, but